investment, investment, and investment. I think in the last year's budget, if you look at, this was the theme of the budget. We don't change themes every year. So there is a need to continue with that theme. And our sense is that not only in rupees trillion terms, but also as a percentage of GDP, there is a need to increase the public capex part. And increasingly what the central government is realizing is that it's only a limited areas where the central government can make a lot of capex. The power lies often with the state governments. So it's quite keen to deliver a larger amount of resources to the state governments to spend as well.
But when I speak to bureaucrats and ministers in the government, what I find is a growing sense of unstated frustration with the fact that when it comes to spending, the government is having to do the heavy lifting, and despite the deep and sharp reduction in corporate taxes, private investment isn't stepping up to the plate. And I think Nirmala Sitharaman has publicly spoken up about this a couple of times, nudging India Inc. to do more when it comes to investment. But that, for some reason, doesn't seem to be happening.
So I don't think there is any other option but to be patient. We have to understand that even pre-pandemic, India was going through pretty slow growth compared to what India's history has been. And the pandemic has obviously had almost 2 years of low growth. And now with this whole geopolitical uncertainties, it's difficult for private capex to immediately pick up, given the background that we have seen of last 5-6 years. But what we have to also keep in mind is that we are now reaching almost all the preconditions that are required for a private capex recovery. Look at corporate balance sheets. If you look at the financial system balance sheets, we haven't seen this kind of a balance sheet in almost a decade. So with the right kind of public capex and the policy thrust that is there towards manufacturing that this government has put forward, I think it's just a matter of time we will see a private capex recovery.
But Soumya Kanti Ghosh, this is something that the pundits have been saying for a long time, that capacity utilization is in the mid-70s. India is poised for a multi-year investment cycle, an investment cycle which so far hasn't kicked off in right earnest. Why? And do you think, like Samiran, that that's now finally about to change?
Yeah, thank you, Rahul. No, I think that last 2 years during the pandemic, if you look into the corporate balance sheet, they have significantly deleveraged. And so that's the first thing. So that's one of the preconditions for investment taking off. The second point to note is that if you actually look into the bank credit today, credit growth actually has continued to expand, even though there has been some moderation in the recent weeks. And a large part of this credit growth is not only the working capital requirement, which typically comes when the inflation is on the higher side, but also term loans and also some project announcements, as we are seeing in our books. So in my sense, I think there is evidence of an pickup in private investment activity. May not be that encompassing which all of us want it to happen. But at this point of time, if I look into the sectors which has deleveraged, like steel, like the metal sector, there is evidence of some amount of private investment picking up. But as we progress, and as basically as all of you also, as also there has been a lot of geopolitical conflict and uncertainty. So I think as the fog clears on the global economy also, I am sure that the investment is going to take off in a meaningful manner.
One of the Modi government's big thrust areas is to boost manufacturing and to take manufacturing to 25% of India's GDP. The needle hasn't moved much when it comes to the ratio of manufacturing as a percentage of GDP. In Vietnam it has. And the big question in India and globally is, to what extent is India being able to benefit from a global realignment of supply chains, with many global corporations looking at an India plus one strategy? Is, Pranjal, in your view, India likely to be the prime beneficiary or just one of the multiple beneficiaries of this realignment?
Yeah, I think the good news is that India has gained a global market share in some high-tech sectors like mobile phones, drugs and pharma, automobile parts, and IT services. So that's the good news. But the problem is that we are actually losing global market share in trade in medium tech and low tech. For For example, textiles, for example, small electronics, for example, agricultural products. I think our problem is why our manufacturing to GDP share is not rising dramatically, like, for example, Vietnam that you mentioned, is our industrial structure. We have too small firms which never grow over time. We call it the economic dwarfs. There can be different names to it. The problem is if there are too small firms, they never gain economies of scale. They never become too efficient to sort of, really compete on a global level. And that is, I think, our real problem. And I think the big challenge is how do you let small firms grow from small to medium to large, which is something in our country we don't see too much of.
I had a fascinating conversation with Raghuram Pranjal at the World Economic Forum about manufacturing and electronics. And his argument, and I'm curious to know what you think, is that PLIs is basically subsidy for capitalists, that there is very little value add happening. And while, of course, manufacturing is growing up, there's nothing to tom about in terms of it being a big achievement for the government, that this is money that could be more wisely spent in things like higher education, produce more engineers. That has a higher ROI than just giving money through subsidies to corporates.
My sense is the PLI scheme is an experiment worth doing. We are trying to sort of, look into futuristic sectors and ensure that, India at least tries, right? And the other reason why I think we should do it is because it's actually not very costly. Barring the semiconductors, it's just over 2 trillion rupees spread over 5 to 6 years, which is our 1-year fertilizer subsidy bill. So it's not that much money. And even within that, the money was made possible by retiring some old export subsidy schemes. So there was smart thinking done there, and I think this is an experiment worth doing. But is this enough? Will this change India's future? Will it make it a big manufacturing hub? I don't think. I think a lot more needs to be done. Most importantly, I think overall business climate needs to improve in a way that small firms can grow and become large over time.
Samiran, especially on the issue of value add, opinion seems very divided amongst pundits on the efficacy of production linked incentives. Are they working in your view, or are they not working in the way they should?
So Rahul, in a very broad sense, economists will always argue against subsidies in any context, whether it is a context of in manufacturing or it is a context of food subsidy. Economists have a natural bias against subsidies. But having said that, the way to think about PLI, in my view, is that is it going to be enough to move companies who were thinking about investing in other geographies to come to India? Is that going to give that extra bit of leverage to us? And in that context, it's very important that the first few PLI schemes are success, because I can tell you from my experience that a lot of foreign companies are thinking about India, but they are also fighting a perception battle that in the past, investing in India has been difficult. So if there are some companies which can show that, yes, India has changed and it's possible to do business in India and be profitable, then a lot of players who are waiting in the wings can also join into the scheme. While Pranjal is making a very valid point that the extent of subsidy is still very limited, it's less than 1% of GDP by our current GDP standards. The critical thing is that the sectors on which PLI is there is also less than 1% of GDP. So even if that less than 1% of GDP grows at a very fast pace, that's not going to move the overall GDP growth needle. So either we have to think of this as an experiment which brings in more investment in other non-PLI sectors, or we will have to expand PLI to a vast many sectors for us to see the whole macro impact of PLI. Otherwise, what's going to happen is that this year we will be discussing PLI. Next year when you are going to call me, you are going to find another acronym and we will keep on discussing that acronym without having the continuity that we require.
Now, Soumya Kanti Ghosh, you're very bullish on some of the policy moves that the Modi government has made and their potential impact on Indian economic growth. But like we were hearing in the conversation with market experts before this, the fact that this is India's moment is not being said for the first time. Now, this is something that's been said multiple times in multiple years gone by. And therefore, what makes you confident that this is truly India's moment? Because in the past, we've had the knack of finding some way of snatching defeat from the jaws of victory, or not being able to capitalize on the moment like we should.
Yeah, thank you, Rahul. I think I'll just very quickly quote some data points to support the point that Indian economy is actually placed in a sweet spot. The first is that look into the banking sectors. The net NPA is now at 10-year low. Credit growth is at 10-year high. Look into the digitization. The total number of UPI transactions this year is already touching 100 trillion. That could actually go up to 130 to 35 trillion at this rate, which could be 45% of India's GDP in the current year. Look into the SME sector. The overall credit growth in the current year, 10% is being contributed by the SME sector, and there is now clear evidence that a part of the SME sector is actually getting bigger. That means they are moving up the value chain. Then there is the look into the external sector, export data. Even if last year we did 420 billion, at the current rate we could actually do around 450 billion. This is apart from the services data. Tax to GDP ratio this year could be at the highest level, and India is the only country which has increased and seen an improvement in the tax GDP ratio. So there is compelling evidence of the data supporting that we are in a sweet spot. But the fact is that we need to take advantage of that. In the past also we had done, even in the external sector, we have already recouped more than 50% of the foreign exchange reserves, which is at the lowest level at the end of October. So in rupee, in real terms, it is actually appreciated if you look into the BSI data. So household debt to GDP ratio, look into the latest BSI data, it has actually now declined from the peak in March 2022. So on all counts, we are in a sweet spot. The point is, where do we grow from here?
Okay, so let's come to that, because we saw recently the World Bank enhance India's growth forecast from 6.8% to 7% for this fiscal. I'll start by asking Pranjal first for her broad sense for how the Indian economy is likely to grow next year.
Yeah, I think next year is going to be a bit turbulent and growth is going to slow down for a couple of reasons. One is global trade is slowing. You mentioned that a lot of people are not expecting a hard landing, but it's still slowing across the world. We can see trade volumes that we track very easily slowing. So exports will slow, and exports are important because they were a big driver of our growth when we bounced back from the pandemic. Then if you look at our consumers, a lot of the pent-up demand after the pandemic is now done. If you look at the deposits at bank, they are back to pre-pandemic levels. And then you have a government which is trying to bring down the fiscal deficit. Fiscal consolidation in the short run can take away from growth. So I think for all of these reasons, we will see growth softening in 2023. But we should not worry about it. We should focus about macro stability, keeping inflation low, bringing down fiscal deficit. Because once the global cycle turns, I think India today is really geared for a takeoff. And I would agree with Soumyakanti Ghosh on many of these points he's made. I think there are two very exciting sectors: high-skill exports, where India is doing well, and then the entire tech startups. I know it's slowing a little bit right now, but this consolidation is good. I think in the medium term, our tech startups can find a lot of digital answers to real-world economy
problems. At this
problems.
moment, what's your estimate for growth for next year?
For next year, we have growth at about 5.5%. But after that, we have growth going back to 6% plus.
At this moment, you have no intention of revising upwards the growth figures from what
No.
you did previously.
Yeah.
Okay, Samira, how do you see India's growth outlook for next year?
So it's, as Pranjal was mentioning, that there are some headwinds to deal with, but the way I generally want to look at this number is that if you look at last 2 decades, on an average, consumption has always contributed about 400 basis points to GDP growth, at about 4%, becomes like a absolute bottom for us. And on top of it, if we get just about 7% investment growth, we are at 6% overall GDP growth. So I think 6% kind of becomes a number which is quite achievable. On top of it...
So you're slightly more bullish than Pranjal is.
Yes, I am. I think that the current data is not supporting a slowing economy. So there is right now a big disconnect between the data and the narrative. The narrative is more negative, as some of the things that got discussed earlier about headwinds coming from global slowdown, headwinds coming from fiscal contraction, monetary tightening. But you look across all high-frequency data, there is barely any slowdown in that. We are still running at a rate which is almost pre-COVID growth. So I think I will be slightly more optimistic on achieving a growth number of closer to 6 next year. But obviously global headwinds can change.
So we are getting more optimistic as we go from right to left, from 5.5 to 6. Soumya Gandhi Ghosh, are you taking the needle up even further?
No, I think I would tend to agree with Samiran's point. We are a little higher than 6%. I think one possible advantage next year is that prices will actually be rapidly cooling off. So, I mean, for example, oil prices. Also, the fact is that the globally, domestically, I think inflation possibly has seen the worst, the peak, and inflation will progressively come down next year. Food prices has been surprisingly, even after such an bad weather in the last 3 months, I think unseasonal rains, food prices have behaved remarkably well. And with a 46% weightage in the overall CPI basket, if inflation behaves well, which is doing right now, and actually it has surprised a lot of the market expectations and forecasts, I think the stage could be set for a positive GDP surprise next year, because all GDP numbers last year, I think there is a disconnect between the leading indicators and the GDP. Last quarter GDP, the forecast which the NSO gives out 7%, I think that was nobody was expecting. So I think that next year we could see a positive surprise on a back of a relatively stable macro environment where inflation will not be an evil as we have seen this year.
Now, one of the reasons why so many global companies are bullish on India at this moment is also because what's happening in China. But on China, opinion is divided. Pranjal, the one sense is that China's decline in terms of economic growth is now permanent. The number of old people is growing up, the youthful population, working age population coming down, and therefore this idea that companies will look beyond China on the back of the pandemic, on the back of growing trade tensions between China and the United States is now inevitably going to help India. The other thought is that some of the obituaries about China's growth have been written in the past wrongly so, and China is a story which global leaders like to kick down. Look at the manner in which the economy is reopened after all the COVID cases and the deaths stabilize, and because Xi Jinping seems to be showing greater moderation and more pragmatism, China may not be as badly written off as many pundits would like to believe. Where do you see China go next?
Well, look, I just want to make one point here. What we find in China right now is that they are sitting on about $1 trillion of excess savings of households who were in lockdown for 3 years. And as they gear to spend, that will provide some stabilization to global growth. When you made the point that we will not have the hard landing, I think a lot of that will come because now China is reopening and Chinese households and consumers are ready to spend, are ready to travel. So from that perspective, you can't completely write off, a very large economy like China. There are global value chains that are rejigging across the world for various reasons. A lot of people talk about deglobalization in growth and maybe there are in goods and maybe there are not too many opportunities there. But I think where India has a big opportunity in front of it is a continuing globalization in services. I think, we stand in a very unique position. We've been there from the knowledge processing center days to now the GCC, Global Capability Center days, when a lot of large multinationals want to put a lot of their research and back-end work in, places like India. And I think we really stand to gain on that part of the global rejigging of supply chains.
Samir, now two things could happen in China. One, because of pent-up demand on account of the economy and the country being shut for 3 years, China is bouncing back, but this is temporary. It kind of falls to a new level, which becomes the new normal for China. The other is that don't get pessimistic on China just yet because it could bounce back and stay high. What do you think will happen next?
So Rahul, very interestingly, if you look at the IMF forecast for India and China growth, what strikes is that over the next 5 years, India's GDP growth is going to exceed Chinese growth. And that's going to happen first time after 1960s. For 1970s, 80s, 90s, 2010, 2020, 50 years, India's growth has always been lower than China. I think that way, it's an unique opportunity for India. But if I answer your question more directly, there are two things going on in China. One is the reopening trade. The other is the real estate trade. And both things can have very different implications for India. I think the reopening trade, the $1 trillion excess savings that Pranjul was referring to, is going to be spent more on services. That's not going to cause much challenge for India. It's the real estate trade. If the Chinese real estate now starts picking up, that's going to create the next commodity price cycle. And that can destabilize the point that Shomo was mentioning about low inflation in India for 2023 being a tailwind for us. That theory can get questioned. And the last issue is that to what extent this China reopening would lead to a reallocation of capital flows in the EM space. We are already seeing that in the first few days of the year, money has flown or got reallocated from India to China. The Chinese market valuations are much more attractive at this moment than the Indian valuations. So if this continues, then that can become some sort of a headwind. So commodity price effect and the capital flow effect are the two things that I will have to watch out for.
Soumya Kanti Ghosh, a lot of the current economic narrative around China was built at a time when the economy was shut. Xi Jinping acting as the ultimate emperor, taking impractical, irrational decisions that seem to be damaging the economy. The last few weeks, though, at great cost to Chinese health infrastructure, has suggested much greater pragmatism. Does that then mean that a lot of the benefit that a country like India would have been hoping to get out of China's economic slowdown now just stays hawa mein and doesn't actually materialize on the ground?
I think that's an interesting point. But before that, let me just give you one data which Shomiran talked. I think in terms of the stock market resilience, India's the market capitalization is increased in dollar terms 2.3 times than what it was in March 2020. So that's one of the impact of this China. Now, specifically in terms of China, I just want to play a devil's advocate over here. I think China, it's always difficult to believe the data. So, yesterday there were some numbers which were saying that 80% or 90% of the population is already going to get infected. And please note that China doesn't have an effective vaccination strategy for its population, which India actually had, and India was able to quickly ramp up the vaccination for its population and in a war mode. So with the country and given the type of disease it is, the COVID, I think without an effective vaccination strategy, China may be reopening, China may actually, there could be some reallocation of capital. But over a point of time, I think India will stand at a far better advantage because after
once China reopens, and let's assume that 80% of the population has been infected, whoever is vulnerable and susceptible suffers the consequences, a lot of people even die. But then the economy is open and people have immunity. So they can get back to business as earlier.
Yes, but that will take time. For India also, we saw that vaccination strategy played out over a point of time. From May 2020, when they started to vaccinate the people, we were able to vaccinate a large part of the population in 2022 beginning. So if I go by that trend only, with the same population of China and India at this point of time, I think it will take a larger time to vaccinate this entire population. Till that point of time, we can enjoy the tailwinds of the global economy. But of course, as China opens up gradually towards the end of the year, it could be competition between the two.
In the few minutes that I have left, I want to spend time talking about the outlook for GST collections. We've seen GST collections on a monthly basis hover in the range of about 1.5 lakh crore rupees. Is that, Pranjal, where you see GST collections stay next year? Do you see a potential for a moderate to high increase, or do you actually see them come down on a monthly average basis?
Well, it should rise in line with nominal GDP growth. But if you want it to rise even more sharply, like we saw over the last year, I think we need continued reforms in GST. We need to get more items into the GST umbrella. We need to talk about lower, lesser number of slabs, more uniform rates. I think we need more reforms on GST if we want continued improvement.
Which of course
in
every
tax
economist
collections.
and right-thinking person would want. But Sameeran, are you concerned that given the practical reality of this being a general election year, that any reform, whether it is on the GST side, whether it is on tax, or whether it is in terms of pushing through hard disinvestment, will actually now only be seriously considered after the 2024 general elections? Or do you think that the government could potentially surprise?
So just a quick point on GST is that this is a peculiar year where for the first time the central government will be collecting 1.4 lakh crores of GST compensation cess, but will not have to share it with the state governments. So that's going to make the fiscal arithmetic look much easier for the central government. But on the reforms question, I think where I started from is where I want to end with. Public capex is one area which I call reforms, which will have no political ramifications. So it's the easiest one to push even in a pre-election year. If you look at other reforms that economists typically talk about, there are winners and losers in those reforms. And typically every finance minister will be very considerate about implementing those reforms in a pre-election year. So I'm not penciling in too many of those reforms for this year, but public capex push is something which everyone likes, affects everyone positively. So why not do it?
Soumya Kanti Ghosh, are you surprised with the government's approach on disinvestment? Arguably the most vexatious PSU to disinvest was Air India, which got pushed through with a lot of determination, and a lot of other strategic disinvestments, which should arguably have been easier to find a way to push through, have somehow not been done. And are you fearful that given the fact that we have an election, that a lot of this could be pushed out till after the next general elections?
Yeah, I think the answer is both yes and no. In terms of the disinvestment, I believe that more could have been done. But on
this is what economists love to do. They like to give answers which have both yes and no, and everybody else, like normal citizens, wondering, did he mean the yes more than, or did he mean the no more?
I'll explain that. But the good thing is that the government has been able to compensate the decline in disinvestment revenue through a surge in the tax collections. The tax buoyancy ratio, which is historically at 1.1, means that it has been much higher in the last 3 years. So whatever has been the shortfall in the non-tax revenue has been compensated by the tax revenue, and that is because of the efforts which the government has been doing. So in my sense, yes, there could be a shortfall in disinvestment, or may not be that to the extent which we could anticipate. But my sense is that a large part of that will be offset by a buoyancy in the tax revenue.
Now you have to explain the yes and no on disinvestment. It can either be a yes, that they will push through on disinvestment despite it being a general election year, or it can be a no, they are more likely to push it out till after the next elections and not take any panga at this moment.
I think in terms of the disinvestment, some of this is very politically sensitive. Also in terms of the privatization, I think maybe that may not be touched this year. Maybe that could be pushed next year. But there is always this helping hand in terms of the tax buoyancy.
This was an interesting conversation. I want to thank Pranjal, Sameeran and Soumya Kanti Ghosh for joining us at the BIZTAK Market Today Summit and sharing your thoughts on India's economic outlook. Thank you so much. Thank you.